Hello all and welcome back. I hope you've all had a fantastic weekend. Thank you as well for the love and support on the previous video. It means a lot to me. Make sure you are subscribed for future content though, as I'm not going anywhere. There'll be tons of video through over the coming sort of weeks and months, all about crypto and Hedera. That also being said, make sure you're following me over on Twitter, as I do retweet a lot of the information that I cover in these videos, as well as some additional information that I don't always talk about. I also wanted to say thank you very much to 𝗟𝗚𝗡𝗙𝗡 for mentioning me in his most recent videos. If you are watching, mate, thank you very much. Seriously appreciate it. And of course, I do watch your videos as well as you watch mine. That also being said, if you guys aren't following 𝗟𝗡𝗡𝗡 on Twitter or subscribe to his YouTube channel, make sure you are. Covers tons of different crypto and obviously Hedera related news as well. Seriously cool dude, and there's some great content that's really easy to watch. Make sure you are checking him out if you haven't already. Now, what's happened with the crypto market? So on screen is a cryptocurrency market cap chart. This is obviously in Great British Pounds or GBP, and unfortunately we are retracing back to where we were at the beginning of January in 2021, wiped out majority of that additional equity that was in the markets over almost the last 2 year span, or year span, sorry, I should say. Sub £1 trillion of market cap. And unfortunately, a lot of this has come from the information that I kept mentioning, which was the inflationary figure report out of the United States. Many investors and sort of quant firms were seriously anticipating that inflation rates had actually peaked in previous months. And what we saw was the inflation rate had continued to increase month over month, which has spooked the markets, and it wasn't priced in. And that is why we're seeing a further move to the downside, and also the anticipation now of increased Fed rate hikes, which obviously hurt the ability to borrow capital in order to refinance projects, as well as build those cash flow positions for businesses and invest into things like cryptocurrency. So not a great start whatsoever. Some serious point of view from my part though is reflected in this tweet. Don't be like Greg. I wish I'd kept my 1700 BTC at 6 cents instead of selling them at 30 cents. Now that they're at $8, and that was back in May 2011. And what this effectively shows is that majority of these markets and projects do tend to increase over the long term. And what this ends up being is noise in the short term, and many people get spooked and shaken out of their positions. Although it's very important to remember that you should only be investing what you're willing to lose. If you're going to sort of sleep at night now and you're considerably worried about what's going to happen tomorrow with the price action in many of your projects, you are probably over invested in these markets, and you may want to think about reducing some of your position sizes if that is going to make you sleep better at night. It's seriously important that you're only putting in what you're willing to lose, as these markets are seriously volatile. If you fully understood that and you know what you're holding, then this is a bit of an easier ride to sort of sit on and go through. Obviously not the nicest thing in the world. However, this was to be expected. Bear markets happen, they are extended. However, it is a fantastic opportunity to continue to dollar cost average and build those positions. This is where majority of the money is to be made, in these bear markets, in these times of where there are tons and tons of fear. You can see from the Bitcoin archive here, Bitcoin long-term holders actually own 90% of the supply of profit. So 90% of the profit that has been made is retained by long-term holders over for Bitcoin, and this will be the same for the majority of projects. The people that are trying to swing trade, exit and enter positions rapidly to try and time market moves tend to lose out greatly. It's those that have held for many years are the ones that benefit the most from these markets. So where can we go from here? What could happen next? So the Fed will raise rates in the next week ahead, but what Chair Powell says may matter most. And what this is referencing is the size or the magnitude of the rate hike that we're going to be seeing. Previously, we've seen 25 or 50 basis point rate hikes. If we see something higher than a, say, 50% basis point rate hike next week on Wednesday, we could see serious amounts of pressure towards the downside as investors continue to de-risk their portfolios. And obviously crypto being an incredibly volatile asset, they will de-risk that heavily. Markets are fearful of a recession as well. So stock investors are watching the bond market, which is sending fresh signals that the economy could be weakening. What's important to remember here is this is not an isolated incident to cryptocurrencies alone. The S&P 500 year to date as well has wiped out all of its gains near enough from 2021 and has been a complete bloodbath since the beginning of 2022. The majority of markets now want some clear and convincing evidence that the Fed can pull this off without starting a recession. Naturally, if you increase interest rates too aggressively with a large magnitude in a short space of time, you do irrevocably have the power to create a recession in these markets where GDP then begins to contract. And obviously that is not something they want to do. But at the same time, inflation is running away from them, and they may be left with no choice but to do an increased rate hike, which we've not seen yet. And this is what is causing a lot of the fear at the moment in these markets. That is on Wednesday, they'll be deciding the basis point increase for their interest rate hikes. And that could be, or that fuel to the debate about whether the Fed will consider a 75 basis point rate hike and continue at a more aggressive pace. Both Barclays and Jefferies have changed their forecast Friday to include a 75 basis point hike for Wednesday, though other economists still expect half a point. So traditionally, up until now, the Fed has been increasing rates at either 0.25 or 0.5%. There are fears now that they're going to take that up a notch and do a 0.75% rate hike, which would further spook the markets. Therefore, what I will be doing is I'll be waiting at the moment until Wednesday to find out what happens with the interest rates, as we could see further pain to the downside if there is an aggressive rate hike at 0.75% or potentially even higher if the Fed deems it worth the risk. That's my plan, and that's what I will be sticking to. If we do look at the Bitcoin chart as well, we have fallen back beneath $30,000, of course. We are trading around the $28,000 range. And unfortunately, if we don't hold the $28,000 range, we could be easily falling down to the low $20,000 ranges. We can see that reflected in this article here. Bitcoin couldn't hold 29.3K and started dropping down some more, looking at to see how it will hold the $28,500 area and how it's going to react. Unfortunately, if we don't hold that, it could quite easily fall back into those low $20,000 ranges. At the moment, no one has a crystal ball. No one knows where the bottom of this bear market will take us. Hopefully, we can hold the $20,000 plus ranges. However, there is serious possibility that we could fall even further. And unfortunately, that will drag down the rest of these altcoin projects. So again, make sure you have conviction in the projects that you're investing in. I am highly convicted in my blue chips like HBAR, XLM, for example. XRP is obviously always a great hold. The interoperability chains like Quant and Chainlink, I'm always bullish on those, and I know that they have greater potential in the future over some of the other projects in the space, and that is why I will continue to dollar cost average into those positions. Michael Saylor as well saying here, those using the words crypto and Bitcoin interchangeably understand neither. And this is obviously a very important distinction as well. Don't be sucked up into sort of posts you see on Twitter about a particular project or even YouTube videos. You know, even myself, if you hear me talking about a project and you don't particularly understand it, make sure you are doing some additional research to understand what you're investing in before you buy it. The worst thing you can do is take a position, enter a position with your own hard-earned money, and see that fall to the downside. You will be spooked immediately because you do not understand the potential of the project, and therefore you will be invariably upset that you have lost a lot of money and likely to sell out of those positions at a significant loss. Seriously important in these crypto markets, and actually all types of investing across the board. Make sure you're doing your own research. Really, really important. Some slightly positive news is that the number of addresses holding at least one Bitcoin has reached a new all-time high of just over 851,000, just under 852,000 wallets. This is obviously very important to show that there are some long-term holders that still believe in the future of Bitcoin and the cryptocurrency markets, as we probably all should, as we know that the tech is real. Web 3.0, metaverses, gaming, all of these different new and novel use cases of cryptocurrencies and the technology they can provide and leverage existing applications will come to fruition. It is literally happening as we speak. Many different things I've touched on in different videos, use cases, integrations, partnerships, sponsorship deals. There's tons of stuff happening behind the scenes that won't always surface immediately. If we also look at some more seriously bullish news, Jpmorgan wants to bring trillions of dollars of tokenized assets to DeFi. So the bank's recent tokenization of money market funds with BlackRock dovetails with an institutional DeFi project led by the Monetary Authority of Singapore. Now, Singapore should be ringing some alarm bells for you guys, because we've got DBS Bank in Singapore, which is obviously a council member for Hedera. So Jpmorgan hopes it has found a way to decentralize finance developers to leverage the yield generating potential of non-crypto assets. Speaking at CoinDesk at Consensus 2022, Tyrone Lobban, head of Onyx Digital Assets at Jpmorgan, described in detail the bank's institutional grade DeFi plans and highlighted how much value in tokenized assets is waiting in the wings. Over time, we think tokenizing US treasuries or monetary market fund shares, for example, means that we could all potentially be used as collateral in DeFi pools. The overall goal is to bring these trillions of dollars of assets into DeFi so that we can use these new mechanisms for trading, borrowing, and lending, but with the scale of institutional assets. Institutional DeFi generally means imposing know your customer strictures on crypto's permissionless lending pools, which has started to happen in pockets of innovation such as Aave, as well as recently announced project involving Siam Commercial Bank. If we do scroll down further, the second piece of the puzzle is a recent pilot that is being led by Monetary Authority of Singapore and includes Jpmorgan and DBS Bank, as mentioned, a council member for Hedera, market node, and is dubbed Project Guardian. It tests institutional-friendly DeFi using permission liquidity pools that are made up of tokenized bonds and deposits. These ventures into DeFi will involve public blockchains and have a permissioned structure similar in many ways to what is being done of the likes of Aave, Arc, and Fireblocks. One difference, though, is that verifying customer information in Project Guardian is being done by large financial institutions that are participating, as opposed to DeFi platforms and crypto-native custody firms. In other words, Jpmorgan trader has to prove he has the rights and entitlements to trade on behalf of the Wall Street Bank. So what this effectively means, and it is a long shot, it is a breadcrumb, is that Jpmorgan and obviously DBS Bank, being a Hedera council member, could be looking to leverage Hedera Hashgraph to bring DeFi to traditional assets, bring trillions of dollars of tokenized assets to DeFi, potentially via Hedera Hashgraph. I'll continue to watch this and report back on any additional breadcrumbs that come out of it, as it is seriously interesting and could be another huge use case for Hedera going into the future. Something that I recently retweeted as well is Hedera tokens. Many of you have asked about where you can get the correct token IDs for projects built on top of Hedera, and someone has gone ahead and put together this sort of really cool application online called HederaTokens.io, showing you some key level stats on the right hand side of the 24-hour and 7-day positions, as well as market caps, but more importantly, the token addresses of these verified projects. You can request as well for these projects to be added. Now, this is a great sort of knowledge base for all of us to ensure that we are associating the correct tokens and we are trading the correct tokens on the upcoming DEXs that will be released over time. Obviously, we can see some namestays here, SourceSwap, of course, 𝗟𝗙𝗙𝗙𝗥𝗥𝗔𝗟𝗦𝗧𝗔𝗠𝗣𝗏, HBAR, HSweet, SeaKey, TuneFM, or Jam, Dovu, Hedera, USDC coin. We've got Creamies as well, HBARX, and 𝗟𝗓𝗡𝗥. So tons of projects that have already been added, and they are updating this at quite a pace, which is fantastic to see. Anyway, guys, that kind of wraps up this video of what's happening in these crypto markets at the moment. Hopefully you guys did enjoy this video. Please leave a like. Make sure you're subscribed. Lots more content coming in the future. And until the next one, I'll catch you then. Cheers.